I've got a real interesting one for you today. It is Civitas Social Housing, suggested by someone down in the comments, so thank you for that. Ticker symbol CSH. It's got a rather high dividend yield at the moment of 9.81. We'll be diving into the financials, having a look at a few of the websites I use to analyse any stock, and we'll be looking at their website, what they do, and a few other things. So let's jump right into it. Currently, they are trading at 58 pence. Now, REITs over the last 6 months have taken a bit of a beating because the UK economy and a few other problems. And at the moment, it was trading around 81 pence, almost up to 85 in August. And now we're down at 58 pence, which I believe is the lowest it's been in nearly 5 years. So that's something. There's the drop from COVID. It was £1.2 and it dropped down to a low of 78 pence. So it's even lower than its drop back in March of 2020, which is actually not unusual for a lot of REITs and a few stocks at the moment in the UK. But it has produced a really high yield of 9.81. Now, whether that'll last forever is probably unlikely because we're hopefully there'll be a bit of a recovery into the future. So for a lot of people, this might look like a good opportunity, but let's dive into the financials, their website, and see if we can sort of paint a better picture, because something happened in September when it was trading at 80 pence and it dropped. Now, whether these two things, combined to drop the price as drastic as it did is up for speculation. But it was only founded as recent as 2016. Now, what do? They're a large British investment trust dedicated to investments in existing portfolios of built social homes in England and Wales. Unfortunately, not in Scotland or Northern Ireland as of yet. Now, the best place to start looking into any company, I always recommend, is their website. Now, here we can go to the About Us, we're going to look at their portfolio, they have an investment case and a few other presentations. First things first, we'll jump into what do they do? You gotta, never invest in a business you don't understand. So first things first is we have to figure out what exactly they do. They have 835 million invested, 697 properties with over 4,500 tenants. So since we began investing, our approach has drawn another significant investors into a sector with a variety of strategies, and it led to social housing and associated healthcare facilities emerging as an institutional alternative asset set. Now, a few of those words may have just completely blown your mind. That is completely okay. I'm going to decipher that as best I can. Essentially, this fund was set up and has developed into social housing and associated healthcare facilities. Now, what is social housing? Social housing tends to be for long-term care of someone who might, could have something like a disability or something up with them, mental health. And what it is it is several properties around usually a communal building that provides healthcare or, laundry and, they get, assistance, but they live completely independent lives in the privacy of their own property on site. There are a few varieties. It's not the same for all of them, but it is a good starting example. And we can see them at a glance here. Because sometimes the houses can be just completely on their own, independently in an estate or something, and it is rented out to someone. They also could be, normally social housing is linked to the prices of the local area, which makes it a lot cheaper to alternatives like private renting. So that is another thing to consider. We aim to reward shareholders through the payment of progressive dividends. They have been growing over the last couple of years, which has been pretty good. And deliver on social objectives by increasing the availability of social housing, improving the quality of social housing, and offering value for money for the public purse, as they do work hand in hand with the government in providing support and funding, because we can see here on the fourth section, 100% funding support from housing benefit. It is, it's supported from central government with a 24-year unbroken commitment to support vulnerable adults and meet their accommodation and care costs. Now, this has been one of those it's a very social stock. According to statistics, every pound spent in it is actually worth £3.51 to the economy. I think it displays that somewhere in their portfolio, is it? Let's see. Well, here actually, over on their portfolio, good point to start into, is what exactly the care needs could be with these properties. Learning disability and autism, mental health, acquired brain injury, physical and sensory disabilities, addiction, homelessness, and NHS step down, which I believe is, correct me if I'm wrong, that's when you come out of surgery or you're recovering. So you're not in the hospital now, you're kind of recovering and trying to get back to normal. I think that's it. Might be wrong on that one, but you can point it out if so. We can go on to their investment case. Now this is them trying to explain what. We're getting close to what I seen earlier. Was it sustainability, share price tools? No, it's not here. But Telegraph brings you its top 10 ethical funds. That's it, ethical, because obviously social housing is a very good thing, not only for the economy, but for the people that it benefits. And, with other stocks that you could be investing in, there's normally a bit of ethical questions, at the moment it's sort of sustainability, pollution. But this is definitely one of the ones that you can, it makes a list of our favourites that make money morally. So it makes money, off the government and housing benefits, but gives it back to shareholders, and could be one that if you're investing in, you might be able to sleep better at night knowing what the money goes towards. It all depends. It could fit certain portfolios, and it can of course fit certain investors. We're all completely different. There is no straight answer to any of that. Of course, none of this on this channel is financial advice. It's just me going through my own journey and looking through companies. But like yourselves, there's nothing unique about what I'm doing here. I'm not an expert in the field. I'm just, all self-taught and enjoying going through these with you. They have been on the Motley Fool a few times, I've seen. I actually should have pulled up an article. Would have been good to have we read of, but we can continue on to their investment. Where is it? Their annual report. That's what I want to see. Let's go. Now, annual reports can be really large and daunting. I do understand that. However, there's a really easy way to just sort of skim through it. You could go into complete depth, but going to the financial highlights is normally one of the best places to start. So that's exactly where I'm going to go to. You can go through the About Us, their business model. As you can see, an individual with care requirements, they require a home. So the local authority or government or council designs a care package, identifies a care provider and a property for the individual. All right. The care provider is then paid the full amount for the care package and pays the rent to the approved provider, or the approved provider is just paid directly. The approved provider then pays Civitas the rent, and they have quite a lot of approved providers. Their NAV value, I just want to point out here, it's actually it gets mentioned. Where does it get mentioned? Here. The NAV value, that's the net asset value. So that's essentially all their assets added together against the shares that they have. And that produces kind of what their share price is just worth on a bad day, on any day. And at the moment it sits at £1.10. Now, for a lot of people, that's a fantastic indication that it is a very undervalued stock. Now, there's lots of things you have to consider. Their profit before tax is up 24%. The NAV is up. Quite a lot of these is up. The total shareholder return's a bit down this year from previous ones, but their dividends declared's up, annualized rent's up, and property investment is also up. But a lot of these prices could be valuations of properties, and as you know, property prices are at near an all-time high in the UK, so it's something to bear in mind. But yeah, that is the financial highlights that is best looked at. Let's jump over to Simply Wall Street. This is one of the many resources that I use to analyse any stock with myself. Now, I do have the premium version, but you can see all of this. I think it gives think it's 3 companies a month you can look at on the free version. So by all means, it's not hidden behind a paywall. You can look at 3 companies per month for a deep dive, and you can look at them as many times as you want in that month. So that's something pretty cool about Simply Wall Street. They have this wee thing, it's called a snowflake analysis. I know a lot of you may be completely familiar, but for anyone new, I always love to run through it. Gives the valuation of the stock out of 6, all the scores are out of 6. The next 1 to 3 years, 1 out of 6. Past performance is checks 3 out of 6. Financial health and debt, it's 2 out of 6. And dividend is 4 out of 6. So it's a good value average dividend payer. Trading at 51% below its fair value based on a discounted cash flow model. A bit of a complicated formula, but trust me, I will go over it as basic as I can. Because that's half the point of this channel, is just trying to make everything dividend investing accessible to anyone and everyone to try and understand what a lot of these really complicated, mad-looking numbers looks like as best I can. Earnings are forecast to decline. Okay, that's one of the risks here. Debt is not well covered by operating cash flow, but we'll look at that. REITs are a wee bit strange in that one. Unstable dividend track record, again, we'll look at that. And large one-off items impacting financial results. So we can go down here and see their price performance and history over the past. This is the last year. Now, they've had a few things. They've had their dividend increase twice, and they've had a share buyback. Their share buyback was announced back in September of 15. Share buybacks tend to raise the stock price, but it came at a very bad time because REITs and most REITs just kind of collapsed, with the pound collapsing against the dollar and the economy and just everything looking really grim. So I'm going to say either the buyback hasn't fully kicked in, or I've read through it. It mightn't have kicked in just yet, because if the reaction was as negative as it looks, but I think it really coincides with most other REITs collapsing around the past month anyway. Again, possible opportunity for some people, possibly not. Depends how you look at certain stocks. Pay ratio sits at 7.8. Nothing out of the ordinary. Against other REITs, residential secure income, RSI, home rate, Triple Point, Empiric student property, it sits in the middle of its peers. It actually sits with a very familiar face here. It sits with PHP, one of the companies I'm actually invested in my portfolio at the moment. That sits at 7.9. Primary health properties differs to Civitas a wee bit. They do more social care housing, Civitas, whilst PHP is more care homes and actual, health, or not care homes, healthcare facilities, as opposed to social housing. Down here we can see on a discounted cash flow model it is 51.4% undervalued. Now, discounted cash flow model is all well and good to look at it. Don't take it as the absolute. There are many other factors to take into account. However, in this day and age, with all the information that we have, in the past, investors wouldn't have had such an easy look at a formula like this. So we're getting it really handy these days. There is another way to look at it, which is intrinsic value, which we will have a look later on alpha spread. But just one of the tools to help you make as an informed decision as you can. Future growth, unfortunately, it scores only 1 out of 6. It seems to be over the next year it'll do pretty well, and they reckon after 2023 that it is going to decline a bit. However, revenue seems to be growing whilst earnings, seems to drop off a wee bit. Free cash flow, again, sitting at about 37 million. And cash flow from operations, well, they seem to be sitting at the exact same for the future. The industry actually is looking like it's down 10% into the future for annual growth. So the company's not doing too bad against the industry. Actually, it's doing very well against it. Let's go down to past performance. 3 out of 6, growing profit margin, earnings trend, and accelerating growth. Well, we can see here back in 2018 and 2019, they were sitting around earnings of 35 million, and they've grown it quite substantially up to 51 million over the past 2 years, which has been quite impressive, I must say. Now, let's go down to financial health, something to always have a deep look into. Short-term assets, the liabilities. The short-term covers the liabilities. However, they don't cover the long-term, but they do have almost $1 billion in long-term assets. They have been, their debt to equity ratio has been growing over the past couple of years. However, I do want to point out debt is not necessarily a bad thing, and a lot of big companies can use it quite well and invest in new facilities, acquiring new properties and whatnot. So it's not something to be really scared of. What you do need to be careful of is make sure that their interest payments are actually covered by are well covered by their earnings before interest and tax. And at the moment, they're sitting at 5.1 times coverage, which is pretty decent. Now, their debt coverage from operating cash flow is less so, but it is still covered at 10%. You can see here long-term assets and cash and receivables against their equity and their debt. Dividend scores much nicer, 4 out of 6. It is notable, it is high, its earnings coverage and cash flow coverage pretty good. It's not stable or growing, but, well, it is stable and growing over the last couple of years, just not, it doesn't have 10 to 15 years in the books as of yet. We can see here, back in 2018, their dividend was nearly 5 pence per share. It has grown to, now we're sitting at about 5, almost 6 pence per share. But it has been growing. It has been growing its dividend per share consistently. You can see its yield did sit around 4.6, 5%, but it has skyrocketed to nearly 10% over the last couple of months. And the cash payout for REITs, that is expected. REITs are to pay out about 90% of their profits to shareholders. We can see here all their board members. Has there been any insider ban? Yes, there has in the last 6 to 12 months. Although nothing super major. 35,000, 20,000, none being sold, so that's a good sign all the way through. They've 10% is owned by Scanda. I cannot pronounce that. That's some word there. Investec, BlackRock, and oh wow. We do not have Vanguard. Do we have Vanguard anywhere? Wow, Blackguard. Oh, the Vanguard it's down at 1% in this one. Not like BlackRock and Vanguard sort of tend to be side by side most of these investments, wherever they are on the listing. But yeah, that's pretty normal. Nothing major there. Okay, let's jump over to Dividend Max, one of the many dividend scanners that I use. You can just put in the wee search bar here, CSH, you'll pull up Civitas. Gives you a bit of information in their dividend, when it goes X and when it'll be paid. Now, the X dividend date at the moment is the 3rd of November. Now, what does that mean? That means on the 2nd of November, you must own the share in order to get the dividend payment, not the 3rd. Don't make that mistake. I made that at the start of the channel, that mistake. It is the day before the ex-dividend date. And then we've got, well, it was back in August there. So if I had 100 shares, which currently would be £58, I'd have got a payment of £1.43 back in August, and it would have been paid there in September. If I had 1,000 shares, we're bumping that up to £580. It would jump to £14.25. Food for thought, isn't it? And it's paid quarterly, so it's 4 dividends per year. Nice. We can see here by the chart that whilst there isn't a lot on the books for it, it has grown quite substantially to 5.55 pence per year. And you can see here, from 2019 and then into 2020, they seem to be just increasing ever so slightly every quarter, or every year they increase the payment for the next 4 quarters, and it has increased to 1.425. Now, of course, on the 27th of October, they will actually announce the amount for the next dividend, and I expect it to be 1.425. I expect it to be. Whether it is or not, we're not sure. We'll have to wait till the 27th of October, which will be, what's the date today? 24th, so 3 days. Or it's probably long declared by now, and we're looking way into the future. Jumping over to another website I use, Dividend Watch. I actually use it mostly from a portfolio tracker, which you can find a link in the description for these websites if you need to have a look. Gives you a bit of the breakdown, share price, and a nice wee chart here. Some people prefer using different websites. I like to show you the whole array so you can have a wee look. They're all free to use. There are links in the description. Some of them are affiliates, but I like to be very transparent here. They are all completely free to use in their own right. Dividend here, we can see it just increasing. The chart, in the last 5 years it's grown about 7%, which isn't too bad. And you can go into the exact details here, and you can just see that every 4 quarters they just increase. Stock analysis, safety score isn't available for this one. It is a relatively new rate, so I'm not too surprised by that. But you can see here its yield against general real estate in the UK, it's 2% higher in the yield. Stock volatility, there's a bit of a difference there too. And its payout is a wee bit higher, but again, it is a REIT. So that is something. PE, it's pretty accurate there. Fundamentals, and give you a wee bit of annual net income, cash flow, and total liabilities year on year. And if you want more recently into 2022, you can swap it over and it'll give you the most recent quarters as they become available. So you can see net income has been increasing quite drastically year on year, which is good to see, alongside cash flow and total liabilities as well. Okay, alpha spread, I told you all about discount cash flow model earlier, so we're going to look at intrinsic, which basically combines relative value and discounted cash flow model, gives an average of the two. At the moment, best case, it gives it around 86 pence. Now, this isn't the net asset value. This is intrinsic, a little different. You can click here, goes into sort of breakdown as to what it is, and alpha spread, you can check out 3 per week. It's actually per week for this website. So base case, it's given 86.37. Best case gives it closer to £1.09. So the best case is kind of closer to the net asset value, the NAV value, and then worst case, it gives it 77%. But even at base case, it's 33% undervalued, whilst obviously best case gives 47%, and we know Simply Wall Street's discounted cash flow model gave us 51%. Food for thought, isn't it? Okay, Trading 212, this is stock brokerage that I use to purchase all my stocks from a portfolio, so I'll give you just a quick tour here. You can add CSF to your watch list after you search it up. You can set things like price alerts, you can check when the market opens, you obviously buy, you can set stop limits, whatever you want in that one. There's some neat advanced charts for you to use. We've got a wee bit of a breakdown on the company itself here. And go all on down, see sector, industry, market cap, revenue, and then it gives some neat charts here based on revenue and net income. Then we can go down here and see total assets and liabilities, and we can see that at the moment their operating cash flow has been steadily increasing year on year. We'll see how much they actually paid out in dividends last year. They paid out, well, this year actually 33 million, and last year 33 million again. Not bad at all. You can see it just ever so slightly increasing, probably due to just a slight increase of dividend per share. But yeah, that is Civitas Social Housing done and dusted. Let me know what you think in the comment section below. Is there any other companies you'd like me to look at? Also, is it in your portfolio? Is it a share you'd be interested in picking up? Let me know. We'll have a discussion in the comment section. Thank you as always. I'll see you in the next one. Bye bye.